Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is July 1st of 2024, first day of the second half of the year. And before we begin, definitely want to wish everyone a happy July 4th holiday. And hopefully that everyone can spend a lot of time with their friends and family that they love, and certainly celebrate a little bit of what makes this country great, right? So despite all of the political issues out there, we live in the greatest country in the world. And I think that the fact that there's so many people that want to live here speaks and is a testament to how great our country is. So I'm certainly grateful to live in the US, and certainly grateful in terms of how great this country is and the opportunity that it provides for so many people. But with that said, let's get into the update. Now, quick recap from the first half of the year. What we saw was a little bit of a sell-off in January and February, big rally. If you noticed your growth accounts in March, April, and the first half of May. And then really since the second half of the May, we've seen a pretty big pullback off that top. In June, the second half in June in particular, we saw a pretty big pullback for our growth portfolios. Now, that was mainly driven by the pullback that we saw overseas in Asia. So Asia had a really big rally off the bottom. Remember, they're in an early stage recovery versus the US, which is in the second or third year of its recovery. Now we're getting that first pullback off the bottom. That is natural for markets that are bottoming out and entering a new bull cycle, which is what we believe is happening. So for us, we see stocks that had a big rally in Asia, have pulled back. We call it a 50% retracement off the initial rally right into the breakout point. Right about now is where we would expect for these oversold conditions to resolve themselves and begin what we call the second stage higher. As that second stage higher begins, which we believe will happen, of course, not guaranteed, but that's where we think a lot of that outperformance comes from. So that's what we're going to be doing a lot of work on this week in the update. Additionally, we want to talk about the debate, right? So this is not a political statement. Our job is to figure out what may happen in the economy with individual stocks and businesses and sectors, but also politically, because the political atmosphere does impact stocks and their valuations and ultimately the prices that those stocks trade at. I think it's fairly consensus to say that the Biden performance last week during the debate was a disaster. And it spiked the odds of a Trump victory in November. That's not a statement saying that we support Trump or we support Biden or vice versa. It's a statement of saying, based on what happened during that event, based on how we're seeing the Vegas odds play for likely victory, it seems to be that a Trump victory looks much more likely. So to provide some quantitative data to that, Vegas odds show the likelihood of a Trump victory after debate spiking from about just over 50% to over 70%, and the Biden victory likelihood plummeting to the high 30s. So we have to pay attention to that and what that may mean for sector allocations of stocks and businesses in the economy as a whole. So this week, we're going to go over that. We're going to go over the growth and income portfolio, what's been happening there, any changes that we've made in those portfolios. We're going to review the pullback in China and emerging markets like we talked about and what we think is going to happen next there. And then lastly, looking at the S&P 500 cap weight, which is the index that we're all used to seeing in the media, versus the reality under the surface, which is the S&P 500 equal weight. So making sure that we're positioning portfolios not for a bubble or not trying to chase a handful of stocks that are optically driving performance, but for what's really taking place at the end of the day in the market. So when we look at 2016 and what rallied when Trump won, it was the banks. The banks were the big winners, in addition to cyclical stocks such as the industrials and consumer discretionary stocks and real estate. Those are areas that really did well off of the 2016 Trump victory. Now, we want to use it as a blueprint, but not as a promise, right? And what I mean by that is the difference between now and 2016 is that 2016 was a shock. Everyone went into the night of the 2016 election kind of assuming that Hillary Clinton was going to win, and then you woke up with a Trump victory. This time around, I don't think it's a surprise to say if Trump wins that most people would have expected that. Now, a lot can change, especially in this election cycle between now and November. But as of now, it's fairly consensus that Trump would win, and perhaps in a landslide. So we want to understand the types of dynamics that may happen. So that may mean stuff like the banks, stocks like the banks may rally earlier. So what we want to understand is, should we buy banks? Should we trim from other areas? These are things that we ask ourselves every single day, but just good to be aware of in general. And the big reason why the banks rallied is because of deregulation. One thing that Trump definitely campaigns on and did in the first term was deregulate the economy, which the banks are one of the most regulated sectors. So that is definitely a sector that could benefit from a stock price perspective if you see a Trump victory in 2024. Now, in terms of portfolio highlights, the growth sleeve underperformed in the month of June. Why was that? Pretty big pullback across emerging markets after a strong April and May. Now, remember, bull markets, no dissimilar to what's happening in NVIDIA and tech and other areas that are in bull markets, you get pullbacks. And sometimes those pullbacks within an uptrend can be painful. And June had a pretty big pullback. But the good news is, year to date, those numbers are pretty good. And we want to continue to focus on these areas because we think this is one of the most underpriced and cheapest areas to obtain healthy growth across the entire planet right now. We are incredibly excited to be invested in this area. We also did add Tesla as a holding over the past week in that growth sleeve. Main reason there is that a lot of the risk that we've seen from the EV leader has been priced into the stock, in our opinion. While you have seen a lot of their competitors flirt with, if not go into bankruptcy. So we think there's an opportunity there to play the stock over between now and the end of the year and see a repricing as the EV market becomes increasingly concentrated amongst just a handful of competitors versus a bunch of startups that are competing on price. On the income side, things continue to click along nicely. So the current yield to maturity, so that means the running yield on that portfolio is sitting just over 9% right now as of June 28th, 2024. Main reason for that is, yes, we saw rates come down in the month of June, but we also saw spreads widen out for corporate bonds during the month. So we've been able to maintain those higher yields. Now, once you're in, right? But for new clients that are kicking the tires, we saw some really attractive interest rates that we can offer in the income portfolio. So if you're worried about the election, which we definitely do not recommend making a decision based on that, but if you are worried about a stock market sell-off in the back half of the year, you still want to grow your portfolio and you're happy with 5 to 10%, this could be a good option or something to consider while de-risking your portfolio. These returns are not guaranteed, but the running yield gives you some room for error. And that's what we really like about the income portfolio in the current environment. Now, in terms of the market overview, when you get a strong first half of the year, you get a bit of a historically, you get a bit of a choppy summer because you're consolidating those returns, you're digesting those returns. And then sort of called October, November, December, you tend to get a strong finish to the year. And you can see that. So when we have on average, when we have strong first half performance, call it anywhere from 10 to 15, 20, 30%, the next month, you're only up historically anywhere from 2% to 1.8%. But then look what happens 6 months later. That market performance jumps to about 7.5%. So in years where you get off to a strong start, the first half of the year, strong start, consolidation, digestion, maybe a pullback, and then a reacceleration into the end of the year. Now, what could cause some digestion or perhaps even a pullback in the market? Well, first of all, sentiment is very, very bullish right now. So if we look at past sentiment peaks that coincided with a pullback in the market, And the sentiment right now is very concentrated in one pocket of the market, which is tech and large cap growth within tech. So that is an area right now that we essentially have 0% exposure in. We want to be very clear that we do think that's a bubble. That is an area of danger. It doesn't matter if we missed the last few weeks of returns in that little pocket. We're willing to sacrifice that because once it turns, it's going to turn violently, in our opinion, to the downside. And that's not because the companies aren't great. They're fantastic companies, some of the best companies in the history of corporate America. But the stocks are really, really, really expensive. And everyone, and I'm using a figure of speech, but the consensus is piled in. The crowd has piled in. And then the other factor is cash levels are very low. So back in 2022, when cash levels reached historic peaks, that was a sign that perhaps the market was starting the bottom. Again, cash levels right now are very, very low. And again, we talked about those extreme tails that were driving the market, the S&P 500 cap weight versus equal weight. We can see here the equal weight index is only up 4% year to date, right? So I want to put that into perspective. The average stock, you look at the S&P 500 equal weight, where NVIDIA, Microsoft, and Apple don't represent over 20% of the index, but in equal weight across 500 stocks, it's only at 4%. When you give NVIDIA, Microsoft, Apple, and Amazon their cap weight across the S&P 500, it's up almost 14.94%. So what we're saying here is that you got this like very small group of stocks, 4 or 5 stocks amongst 504 stocks within the index that are pulling the entire index up. Strip those out, and you have almost a flat year. And I think you see that in terms of the way the market feels if you're trying to make trades outside of those group of 5 stocks. And you see that here in the charts. So this is the Magnificent Seven. That's your Apple, your Amazon, NVIDIAs of the world. And then look at that. Obviously, you can see here, very extended, very overbought. But then look at the S&P 500 equal weight. We're actually down over the last few months and pretty much flat for the year. We look at the Dow Transports, off significantly from its highs, and the MSCI EAFE, which is your international stocks, obviously they peaked in mid-May, like we talked about earlier. So these charts just paint a picture of a market that's where the performance is coming from one small, very tiny corner of the market. And we can see that here with flows. Most of the investor flows are going into tech. Almost everything else is negative to neutral. I mean, this is unusual. This is very, very, very unusual. So again, we think the value is in all these dots over here, all these sectors. This is your bubble outlandish peak over to the right, top and to the right. Now, in terms of China, I want to put the rally and the pullback into perspective, right? So Chinese stocks bottomed. So this is your e-commerce index in China, in the black chart, bottomed in mid-January, rallied about 41%. And we saw a really strong rally, as you can see here, from mid-April all the way to mid-May. We felt that, right? Because we're overweight these stocks. Since then, you've had about a 16% pullback, right? All the way from just over 32 down to 27. Again, we felt that as well. But what we pay attention to is not this or this, but the trend, right? So if you remove this this big hump here, that's clearly an overbought condition, or anything below this line, you see generally a positive trend and an emerging new bull market. So what we see here is now the stocks have pulled back into that 200-day moving average support. This is right about where we would expect these stocks to respond if we're in fact in a new bull market. So very important couple of weeks coming up where we want to pay attention to the performance of these stocks. They're incredibly cheap. So we think there's a lot of margin for error here. And we look at the Hang Seng index, which has greater liquidity, it's holding up a lot better than your Shanghai index. Again, very indicative of the market's trying to tell us something. Yeah, everyone's over there in the US and technology stocks, but something's happening here where it's hated and maligned across the world, but these stocks are trying to tap you on the shoulder and tell you something. Hey, we might be ready to go, right? So that's what we're trying to pay attention to versus where the rest of the crowd is. And then you see what copper is doing. So to understand copper, you need to understand China. China is by far and away the vast majority of demand for copper across the planet. Copper, similar to Chinese tech stocks and the rest of China, rallied strongly from March, as you can see here, into April and into, guess what, mid-May. Now, what has it done since mid-May? Retraced all the way back to its 100-day moving average. And guess what it did on Friday? It started to rally. So right into that support. This is your consolidation over the course of the last year. Strong breakout, pull back into that breakout point, and now turning back out higher. We think Chinese stocks follow the lead from Dr. Copper. That's a common trading rule that I believe in and that we're following. And of course, when we look at the S&P, we also look at the S&P 500, we wanted to sort of illustrate how severe the equal weight versus cap weight is. So we look at NVIDIA. NVIDIA is 1/3 of this gap, right? So the cap weight up 14%, the equal weight up 4%. NVIDIA accounts for 1/3 of that. One stock accounts for 1/3 of that. In fact, when we look at the contribution to S&P 500 returns, NVIDIA 33% is far greater than any of the other stocks that we've seen in recent history. So again, all the signs are there about a bubble. And it's not necessarily a valuation bubble, but it's a what we call a piling in bubble or a crowd bubble, an asset flow bubble. And that's what we have to be really, really careful with. When we look at credit markets, again, we think a pullback occurs in the market because of what's happening in tech, not because of where we're positioned. We think that pullback's actually already happened. So as the S&P 500 pulls back, we think our stocks in terms of overseas stocks, emerging markets, China, Europe, et cetera, they start to rally. Right? That's the big setup that we see. But as for something deeper, more economically driven, we don't see that. We don't see evidence of that. We think the economy is softening off an overheated condition. But credit markets, as we can see here, no real warning flags. Like this is 2020 and COVID and the shutdown. You saw credit spreads blow out as the access to credit became really, really expensive. Think of this as your credit card rate. Do you want to have a high rate or a low rate? We want to see credit interest rates, right? The cost of credit for companies be low, right? We want them to stay low. That's good for corporate America. So this is what we're seeing here in terms of the cost of credit remains fairly cheap. So key takeaways here, China and emerging markets pulling back into those breakout levels while US tech froth continues to build. So if we were operating a long short, which we're not, we would be long China and emerging markets while shorting US large cap growth. That would be the big trade that we would be looking at for the second half of the year. But since we're long only, we're playing China, EM, MSCI, EFI, a lot of these cheaper stocks that are overseas. That's where we want to generate a good outperformance for the second half of the year. Three other things, US stock market leadership is very, very narrow. Please don't try to chase these narrow group of stocks that we think are in a very frothy condition. We certainly learned lessons in 2022. And if you go back to 2000, lessons are to be learned from those prior cycles. We are positioned for a bottom across emerging markets. And lastly, banks were the big winner from the last Trump victory. The past does not represent the future by any stretch of the imagination. But I think the big takeaway here is you'd want to look for sectors that benefit from deregulation and relatively, well, deregulation would be the big one, but also higher nominal economic growth rates, because Trump is a big fan of looking at nominal growth and trying to drive up that growth through deregulation and, yes, higher spending. He tend to be more fiscally loose than your traditional Republicans. So that's what we got for you this week. Have a wonderful, happy, and fun and safe July 4th weekend. And we'll speak again in the coming week. Thank you.